You're listening to the Multifamily Mentor Show.
My name is Terrence Doyle.
And I'm Chris Lopez. You probably know us from the BiggerPockets Real Estate Ride Along Show. Well, now we're talking everything multifamily. We bring in top industry experts from around the country to come join us in our Denver studio for an in-depth, in-person conversation.
We're going to be diving deep into deals, underwriting, raising capital, and everything in between. Join the conversation.
What's up, BiggerPockets? Welcome to one of our bonus episodes for the Multifamily Mentor Show. Now, season 2 just wrapped up, but we're able to squeeze in another fantastic guest who happened to be in Denver for a very big conference. Terrence, who's in the studio?
We have Joe Fairless in the studio. Super excited to have him. I think we booked this a year ago. So we've been waiting with anticipation for a year, and super humbled and grateful for Joe to stop by before he has a full-time commitment at the Best Ever Conference in Denver. So Joe, welcome to the Multifamily Mentor Show.
Well, thank you. I appreciate it, and looking forward to our conversation.
Yeah, it's going to be really good. So before we started this, we were talking to Joe about some of the things that he's going through right now and looking back on his career. The audience, as most of you know, is 18 to 26, and what we call rising stars. And so we wanted to make an episode, from someone that's done hundreds of millions of dollars of deals, construction, property management, investor relations. I mean, he's done the entire, food chart of roles and things to do in multifamily. What are the things that would apply to the audience here of rising stars? And so we're gonna start with getting started. And so Joe, maybe take us back to getting started, your first deal, right? Before all the books, before the podcast. Talk to us about your first deal and what really triggered you wanting to get into multifamily.
I had a full-time job. I was living in New York City, and my goal was to make $100,000 by my 30th birthday, and as a W-2 employee. And I accomplished that by, I think I was 28 or so. I was the youngest vice president of a New York City advertising agency. And then once I accomplished that financial goal, I realized that I wasn't fulfilled. What I was doing, I was chasing a quantifiable metric. And then once I chased it, there wasn't much substance underneath that. I realized I was like, okay, well, I accomplished this, but now what? That didn't give me the feeling that I was seeking. And so I started studying personal development. I'm a huge student of Tony Robbins.
Very cool.
And he talks about the 2 keys to fulfillment, growth, and contribution. Mm-hmm. And I didn't know it then consciously, but subconsciously I kind of picked up on that, where I wasn't fulfilled by what I was doing. And so what I did, I started sampling life experiences while I had my full-time job. And what that allowed me to do was test out certain things while having the safety net of a W-2 income, and then see what I liked and what I didn't like. And one thing that I was testing out multiple things. One, I did improv to be improv to be a better public speaker.
Dude, you have guts. That's impressive.
So like New York City underground bars, you were doing improv?
I took a class on improv in New York City, and the teacher said, well, what are you in here for? I told her, and she said, well, if you want to be a better public speaker, improv's not the thing, because with the audience expectations of improv, they know that if you're given this pillow, then you're seeing this for the first time, and you got to make something funny about it. And so the audience expectations are lower because they know you're doing things on the fly. But she said, if you do stand-up comedy, well, now you're supposed to make the audience laugh every 7 seconds. Wow. Because you're coming in with a planned bit. And so you better be prepared. And so that's really a closer cousin to presentations than improv. So I did stand-up comedy. And I was terrible at it. Absolutely terrible at it. But it was an incredible experience. A Gotham Comedy Club, I ended up doing it. Wow. And one other club, and that has since shut down, to give you an idea of the quality of venues I was at. That's no longer available.
So improv over Toastmasters, huh?
Yeah.
Really?
Stand-up comedy.
Stand-up
Yeah, stand-up
comedy.
comedy. I mean, I haven't done Toastmasters. I've been in one of the meetings as an intern at another advertising agency. So that's a legit too. I mean, at the end of the day, if you're doing any of that stuff, you're improving, right? And so that's the key. But
so when you say stand-up comedy didn't go well, were you like in front of people giving jokes and they weren't laughing? I mean,
yes,
because that to me seems like that seems to me like one of my biggest fears in life. Like staying up there, I'm trying to make the audience laugh. I'm giving them my best, like I'm giving them my best stuff, and then they're just like
you've planned, you've prepared, you've thought through. It's funny in your head.
You're right. You can't even get a courtesy laugh
when it comes out of your mouth. Yeah, it's not.
Drops dead.
The first stand-up comedy show at Gotham Comedy Club, it was a very friendly audience. I invited all my friends, and I got courtesy claps. But then the second one, the one that shut down, that was because a friend of mine hosted the comedy show, and he just brought me in. And so nobody knew me.
Right.
And nobody laughed.
There was no courtesy. You got no courtesy.
Nobody laughed. So sampling life experiences. One of them was that. Another was I was teaching a real estate class on how to invest in single family homes in markets that cash flow. I'm from Texas. I was living in New York City. And I was teaching people how to do that while living in New York City, because they would ask me, hey, you've got rental property? How do you have rental property if you're working this, with me and we're working crazy hours? I mean, advertising in New York City is a 9 to 9 job. I mean, it's crazy hours.
Right.
And so I said, okay, I'll start teaching a class on this. And then I heard from one of the people who attended the class, he's a former boss of mine at another agency. He said, this is great. These single family homes buy it for $80,000 at the time, $80,000. It rents for $1,200, $1,100. But if you ever do something larger, let me know. And I realized I had customers before I had a product.
Wonderful.
And that's very advantageous, right? To me, if you have any entrepreneur, if they have customers before they have a product, they're
struck gold. Yeah.
They're in a good spot. They're in a good spot. So then I started learning multifamily, read books, and then I ended up buying that first property.
So to give a little context, so what year was this?
2000. I left the advertising industry in December of 2012.
But when you were teaching the classes and doing the improv, and
that was like a year or two leading up to that.
Okay, so 2000. We're talking maybe 2009, 2010.
Yeah, around 10 probably.
Okay.
Yeah.
Go ahead.
Oh, you touched on something very interesting. You said you sampled life experiences while doing a W-2, and as Terrence said, a lot of our audience, they are, they're a young crowd, and people go through this mental exercise a lot of times where they have a job or they have a career, but they want to make a transition. And especially now with all the Instagram influencers and these crazy headlines about going from zero to hero to millionaire in 90 days. Like, I've been there before, and a lot of other people have as well, like the internal conflict. Do I just quit my job and jump in and have blind faith and go, go, go? Or how do you balance out that sampling and figure out what fits for you personally, professionally, investing wise, while also, you got to have a safe base on some point. Like, what would you recommend to someone who's 22 getting wisdom from you? Like, how would you tell them to balance all that?
I remember when I left the advertising industry, I sent an email to my family. I said, basically, I conquered. I didn't really conquer it. I said in the email,
your goal. You got the 6 figures.
I conquered, and I don't care about it anymore at all. And so I'm going to leave. At the end of this month, I'm going to leave the advertising industry. And I remember getting an email from a family member, and he said, "Man, that's great, but you want to make sure your house is in order and that you've got like what you need financially. Otherwise, things could crumble." And it's true. I had $50,000 because I completed me leaving in December was contingent on completing a refinance on one of the homes. And I would get $50,000. So I had $50,000 in the bank to make it. And that was from the refi. So I had some money, and living in New York City, it was probably going to last
3 weeks.
Yeah. Well, I was very frugal with my living conditions, and that's a whole nother story. Always had a roommate.
Okay.
But it depends on how much pain they're associating to going back to where they came from. it would have been incredibly embarrassing for me to go back with my tail between my legs to the advertising industry. And I wasn't going to do that. To talk to my family, like, hey, it didn't work out. Now I'm going to get the job again. It's just that wasn't an option. But I don't think everyone's wired that way. And I think it would be prudent for most people watching this to do it on the side until the full-time thing becomes a nuisance because your side thing's growing to a certain extent. And that's what happened to me. I was getting paid at my advertising job, but they would email me with projects and I would get annoyed. And I think, wait a second, no, I'm on payroll here. Like, I should not be annoyed by them emailing me work because I'm being paid to work. So I think that wait for it to grow to a certain point, and then you can make a rational decision of, okay, it's at a point now where I can bounce. It's a reasonable risk.
Yeah.
Now that might not work for everyone. It might say, hey, get out and just quit your job tomorrow. And that could be best for someone. It just depends on the individual.
But I love your answer. Like, it just depends so much on the person.
Yeah.
I think it's a good reminder as people out there getting flooded with, all the headlines and crazy success stories. Realize you don't have to go that path, but it depends on your situation.
Totally.
What's disgusting about right now is we live in an instant gratification society. Mm-hmm. You talk about the Instagram here. I mean, I don't have Instagram, but yeah, that stuff's all over. And yeah, it's when you build something that is what you two have built, it's not overnight, and it's a lot of work. It's a lot of dedication. It's putting in the effort daily and building up to that point. And yeah, I thought whenever I left the advertising industry, I was going to do a consulting program, and I was confident because I had watched all these videos and on how to get a lot of people in my mentoring program. I was confident I was going to make $1 million in like 3 months. And I wrote a check to myself for $1 million, kept it in my wallet.
The Jim Carrey?
Yeah, Jim Carrey thing I heard about from Jim Carrey. Did not happen. It was years.
So you weren't going to go into syndication. You were going to go into consulting. You were going to maybe more coaching, mastermind, education.
I was going to I was focused on buying properties, but I saw the consulting thing also as a way for single family homes.
Got it.
Because I had single family home stuff. I saw that as a way, but it didn't work out.
So 2 things I really like that stood out of what we just talked about is, the audience, you're out there, you're in high school, you're in college, maybe you're post-college in a job, you're unhappy, is, the number one thing I think is keep your overhead low. You have so much optionality in our society to do multiple things at the same time if you keep your overhead low. If you're buying new clothes, shoes, watches, cars, spending everything you make, you're not going to have the options that Joe had or that I've had or Chris has had. The reason he was able to take that leap and now build $100 million, multi-million dollar company is because he kept his overhead low, right? And I think the second thing is he was very curious. The thing I love about that story that I've never heard before is, you had reached a goal and then you realize, hey, this isn't bringing me the fulfillment or the contentment I thought I wanted. Let me go try other things. And even though those things didn't work out, it eventually led you, to what, some other amazing things you've done. And so I think those are 2 key things that I took from what you just shared that I hope that people can listen and really take note of and apply to their own journey. Because anybody can apply those 2 things. Stay curious, try a bunch of new things, even if they fail, and keep your overhead low. Mm-hmm. I mean, that's one of the big things for me in the conversation around college and going to college is keep your overhead low, stay out of debt, because that will give you unlimited optionality. And optionality is what gives you the ability to find what the right thing is and find your path and find, what your sweet spot is. So continue down that story. So you thought, consulting, and then what ultimately led you, and you were doing single family. So what led you to your first multifamily deal? How did it come about? I'm guessing then you didn't have a bunch of money to put down for earnest money and to do all these things. So talk to us about kind of the nuances of that first deal.
Yeah, first deal was found through a mentor that I had paid, and he knew of the deal. It was in Cincinnati, and I thought I could raise about $250,000 for my first deal. So previously I was looking at 30-unit properties at the time, which at the time that would be a down payment for a 30-unit in Tulsa, Oklahoma. because I was initially looking at Tulsa. So I told all my investors, all my friends who I knew, I had no investors, all my friends that I knew, hey, Tulsa, Oklahoma. And then I was presented this opportunity in Cincinnati, Ohio, a place that I might have driven through once in my life. But other than that, I was not familiar with it. And I certainly hadn't been telling my friends about Cincinnati, Ohio.
Right.
And so there was some whiplash there whenever I actually presented it to my friends. And I thought I could do $250,000 because of that former boss of mine who said, hey, if you ever do something larger, and maybe a couple other people. Well, turns out when they initially presented that deal, it was a 168 unit deal in Cincinnati, Ohio. When they initially presented the deal, it was going to require about $400,000 in equity. And the reason why 400 with that larger property, it was a master lease with option to purchase.
Okay.
So we weren't actually buying it. We were doing a master lease, which is a whole nother topic. And then as I got further into the negotiations and further into the deal, it increased from 400,000 to 800. Actually, 800,000. Yeah, 843,000 was the final raise. And on top of that, I raised $843,000 from 12 friends that invested on that deal, and it was crazy hard. I mean, it was incredible because I'd never raised a penny before, and rightfully so. They were skeptical and unsure if I could deliver. Well, the deal lost money, so the ones who were skeptical were right. I ended up paying back my investors plus 14% annualized return out of my own pocket. And I'm fast forwarding a whole lot, but I want to get to this point for everyone listening, the ones who are starting out. Hey, I mean, first deal doesn't have to go right. It's how you approach what goes wrong, and how you carry yourself after that. So the deal lost money. I can get into some specifics of how I messed up for how the deal went wrong and lost money. I'd be happy to, but deal lost money. I had 12 phone calls with 12 investors, and I spoke to each of them, and I said, it's going to lose money. I will pay you back. I don't know when, but I will pay you whatever I can every month until it's paid back plus 14% annualized return. And I ended up doing it. I did it. It took me about a year and a half to maybe 2 years. I don't remember exactly. But yeah, I got a Ruth Chris gift cards from one investor. I got a 3-page handwritten note from another investor thanking me. I got one investor has invested with my company 20 plus times now.
Wow.
And yeah, I realized, there are a lot of tactical things we could talk about if we have time, that I messed up on. But the macro level thing that I messed up on was, I was trying to do it all, and I didn't have the expertise to do it all. My background was advertising. I was an advertising major in college. I had a portfolio of 4 single family homes in Dallas, Fort Worth that I had a property management company manage on my behalf. So I didn't have any asset management experience. My thought process, as ignorant as I was at the time, my thought process was, hey, I'm going to buy it. It's going to be like my single family homes property management company. They got it. I got a pro forma. We're good, right? They got that on lock. We're good. And I'll just, let the property cash flow and we'll make money. Didn't happen that way. And so what I realized is, I'm good at certain things. I'm average at certain things, and I'm bad at other things as it relates to the business. Well, and in life, I guess, but as it relates to this business. And so I identified where I'm good at, and then I found a partner who is exceptional at the areas that I'm good at, or not good at, or average at. And off we went. The first deal, we formed Ashcroft Capital in August of 2015. And because our skill sets complement each other really well, and I'd say we're pretty darn exceptional in the areas that we focus in. And it's because we're able to focus in those areas that allows us to be exceptional. we've taken off, and we have $1.9 billion worth of assets under management now.
Wow. So from that one deal losing money, you've been able to go since 2015, 7 years later, to 1.9 billion under management.
Yeah.
Amazing. And I think the thing that sticks out to me, which we talk a lot about, is just being self-aware, right? Being self-aware, understanding, hey, this is what I'm really good at. This is what brings me joy and fulfillment. These are my strengths, the highest, best use of my time. And let me go find complementary partners or employees that are strong in these other areas.
Yep.
You agree?
Yeah, absolutely.
Being self-aware. And the way that I've done that, right? I did the same exercise in college. I've transitioned multiple times in different careers, but the way that I've done that for myself is I went to 5 people closest to me. 5 people close to me. I said, tell me what I'm good at, right? Because sometimes we're blind to our own strengths and weaknesses. Sometimes in our mind, we think, oh, I'm really good at this, when in reality, we're really good at this over here. And I think the number one way that I know to do this is to email or text or call 5 of your closest family members, friends, just people that are going to be unbiased, not afraid to offend you. And they're just going to tell you point blank, hey, here's what you're really good at. And here's what you're not good at, right? And for me, it was building relationships, creating opportunity, bringing people together. Mm-hmm. Since college, people, coaches, teachers, teammates have said, hey, here's what you're really good at. Here's what you're not. And every decision I've made since then has been filtered through, hey, here are the 3 things I'm good at. Everything I do and commit to needs to be, inside of one of those 3. And if it's not, I either need to hire that person or partner with them. And it sounds like that's exactly what you're able to do. Do you have any advice, for those of you out there that do the exercise, realize what your strengths are? What advice would you give to someone out there who's 24, really wants to get into a business, realizes what their strengths are? How would you go about finding in today's world a partner or an employee let's talk about a partner, a business partner that's has complementary skill sets?
I love that exercise. You get that book from the 80/20 book.
I don't remember. I was listening to a podcast.
It's listed in that book, and I have my friends do that exercise as well. It's a wonderful exercise. I'm glad you mentioned that. Well, after you do that exercise, though, there's a next step also, and that is, what do you do with that information? Mm-hmm. And in order to know what to do with that information, you've got to know what successful characteristics make up the business that you want to be in. So you're good at relationships, but how does that apply to the actual business? And so it's doing research on what you want to do and knowing what are what is required to be successful. And then you be like, oh, well, relationship, money, got it. I got that. But these other things I'm going to need help with. As far as finding a partner, I'm glad you asked, because that is a term that gets thrown around a lot with real estate, rightfully so, because you do deals and you can partner with other people. Well, the thing that most of us don't realize is that there's a massive opportunity cost if you pick the wrong partner. Mm-hmm. And I'll tell you a story of a couple people who I know. One person, she is really good at finding money, and she has experience doing deals, larger commercial real estate deals. She was looking to fill a gap on her team that was trying to get more deals in her pipeline. So she was looking for someone who could find the deals and oversee that process. And so she brought on someone and gave them equity as a partner. Well, that person was previously working at a loan originator for multifamily, knew underwriting through and through, like amazing, had no relationships with other brokers, with brokers, couldn't find deals, amazing at underwriting, and had a decade plus experience in the multifamily industry, but they're being hired to find deals and take deals to the finish line. And that is, I said a couple stories, that is a microcosm of multiple people that I know, where we seek out partners, but we don't qualify them enough. And that's a massive opportunity cost that we are putting ourselves in. And the key is, we never should train our partner. If you're partnering with someone, don't ever train your partner, because that partner should immediately elevate your business by filling the void that you're bringing them on to do. it's okay to have someone that you train, but they're not a partner. They're an employee.
Right.
They're an intern.
Yeah.
They're not a partner. A partner immediately fills that gap and is the solution to what you want them to do for your business. So a question to ask when you're looking for partners is, have they successfully done exactly what I'm bringing them on to do before? Have they successfully done exactly what I bring on? If they haven't done exactly, they're not a partner. You could work with them in some capacity, but they're not a partner. How you find partners, all sorts of BiggerPockets.
Yeah, BiggerPockets maybe. Yeah, best ever conference.
Best ever conference.
Yeah, there's a lot of good ways. I think there's a lot of masterminds, mentorship groups. I mean, a lot of the stuff that is out there is ways that I've found other people to find good partners. I think finding good partners is hard. Finding good partners is hard. It's like a marriage. You have to go into it very carefully. I think you should date and try each other out without having an official operating agreement and ownership at stake. Because like Joe said, I mean, unwinding partnerships, very painful, very expensive, and just distracting your energy from growing your business. I love what you said. I think so many people, have worked in certain roles and can put off and give the impression like they can do something. But until you actually can verify that, have you actually done this exact same role successfully? Have you done it over and over and over again to where you're an expert in that field? And I think that's a massive, I think there's a lot of miscommunication and misunderstanding around that, and I think you nailed that. I think that's totally true. And something that, a lot of young, I think syndicators or people in multifamily are constantly trying to bring people on either to raise capital or do this or that. And they fail to verify that they've successfully done exactly what they think that they're getting, right? It's just expectations, right? And just being clear about, hey, this is what I'm expecting you to do. Have you actually done these 8 things, right? And being able to clearly articulate that, I think is really key. So, I think one of the other things that we talked about early on that I'd love to touch on, and we only have a few minutes left, is investor relations, right? Is raising capital. To own $1.9 billion in real estate, I'm guessing you've had to raise somewhere around $500 million in equity, right, in the last 6 or 7 years. So talk to us about kind of your growth in a short amount, what you've done, what you started to do early on and what you've done now, and maybe a couple action points for the audience as they're starting to get their capital raising, side of the business going.
Yeah. I mean, early days, when you're raising money, it's you and you're speaking to the investors. Later days, as you're growing, if you are growing at a pace that is elevating the amount of units that you have and you're getting a larger portfolio, then you can't be the only one who's speaking to those investors. Early days, you likely have close relationships with your investors. For my 12 investors on my first deal, college roommate, current roommate at the time when I was in New York City, a person who high school friend, and just people who knew me really well, former work colleagues. But as you grow, you won't know the individuals who are reaching out to you because they're going to be referred from a friend of a friend, and that's just how that's how things work. Well, the challenge with that as you grow is that the strangers who are coming in are speaking to someone they don't know. That is, your investor relations person once you bring them on. And you've got to have the right team, and you've got to have them positioned for success in order to have investors that you bring in be actual investors who invest with you, not just people who you speak to are interested. And so the team members that you need as you scale would be 2 to 3 people at minimum. 1 would be a marketing manager, 2 would be a CRM administrator, and 3 would be an investor relations person. The marketing manager, their background and their focus is on identifying areas that will attract more accredited investors. They probably have a media planning background. They do not need real estate experience, but they do need experience attracting rich people, accredited investors. The CRM administrator.
For the marketing, this is through whatever channel. I mean, paid ads, networking, just some way to tap into that right audience.
Absolutely.
For that niche. Okay.
Yep. It depends on your budget, or if you have no budget, then it's partnerships. in kind trade, exposure, whatever. And if you do a 5 or 6C deal, then you would have a budget because you can pay to advertise the deal, and then you can have that deal have pay for the cost of those advertisements. The CRM administrator will be an expert in CRM. His or her responsibility is increasing engagement with the people who you do bring in to your audience. So they are focused on drip campaigns when the marketing manager brings in leads from a physicians conference. Then the CRM administrator creates a drip campaign that has information specific to those individuals from the conference. And then that CRM administrator does not need to have experience in real estate either, but they need to have experience working with accredited investors. And then the investor relations person, they do need to have commercial real estate experience. And most important is they have to be a peer of the people they're speaking with. They want to, the investors who are speaking to your team, they want to speak to a peer. They don't want to speak to someone who doesn't have the same professional accomplishments that they have. So those are the 3 team members that are needed. And the key is with the investor relations person is to have that person have the same level of credibility as if you were speaking to the investor. And how you do that is you empower your investor relations person to what I call become a micro commercial real estate celebrity. And what I mean by that is, Magnus Carlsen.
Yeah, for sure. Yeah,
okay.
Yeah.
He might be too much of a celebrity then. Seth Youngman.
No,
okay.
know that name.
He's a Texas Tech blogger, so
okay.
you wouldn't know him. Yeah. So I had to go a little deeper.
Texas Tech,
yeah. So we went from a chess grandmaster to a Texas Tech blogger, but they're both influential in their own right. And what's important is that each of them, Magnus a little bit more public, but each of them, when they speak about their area of expertise, they have at least 1,000 people who listen and respect their point of view.
Mm-hmm.
And it's important to have your investor relations person have that same credibility. So giving them the resources necessary to have a podcast or have a YouTube channel, whatever it is, so that they hit that at least 1,000 people who respect and engage with them whenever they do their thing. And how you evolve from that is you have that individual, and then you have another thing you can do is you can have what I call a content treasure chest. And what a content treasure chest is a bunch of content that you can share with accredited investors, like 3 ways physicians benefit from investing in self-storage or whatever it is, and you have this shared document that the investor relations person has access to, so that when they're speaking to the investor, because most likely they're going to email the investor after the conversation, like that. That's just usually a standard process.
Yeah, common follow-up.
Right. But what probably no one's doing right now, except for our team, is having customized content sent out to that investor based off of how that conversation went and what they were interested in. And that further positions your investor relations person as an expert in the space. And so those are some tactical things that you can do to grow your investor relations team, so that you're increasing the amount of investors who come to you to become actual investors.
So let's role play 1 second, because I think what you just said might be like the pro tip here and like the golden nugget. I mean, you said a lot of great things, but I thought that was really interesting. So let me make sure I understand. So I'm investor relations, you're the potential, we're on the phone, and you're interested in investing. And you're talking about, maybe you're very analytical, right? So you're hot button, we're talking, and you're talking about all these other things you see out there, and you don't like the underwriting, they're too aggressive on cap rates and this and that. So I pick up from our conversation. So I'm talking to Joe Fairless, Terrence Doyle's talking to Joe Fairless. I'm trying to raise money. I work for Ashcroft, and I'm saying, hey, Joe's very skeptical about our underwriting. He's seeing a lot of people out there too aggressive, cap rates, rents, blah, blah, blah. So then I would send you a blog post, a podcast, or an example of our underwriting and how that is, maybe more
Absolutely.
conservative. And that would be, instead of just sending a generic email, we're sending something custom based on our conversation and basically your hot button.
Absolutely. Yeah, and there's the treasure chest, the content treasure chest, which is a silly name, but that's just what I call it. It's got links to a lot of stuff that your team has created already.
Mm-hmm.
And then you can see, okay, this is for this audience, physicians, this is for, engineers, whatever. And then you can easily share that out whenever you're following up with the investor. Because, sometimes on the calls, I don't really do the calls anymore. But I did before. I did a lot of them, a whole lot of them. Probably over 1,000 calls, literally over 1,000 with investors. And sometimes they ask, what should I be asking? What haven't I asked that I should be asking? Now you have a list of things. Well, some people wonder about this. And I'll tell you about it now, but then I'll follow up with an email with some more detailed information about what we've written on this topic.
Yeah. So in my personal company, like I'm just now going through this where I'm starting to think, hey, maybe I'm not the best person to be on the phone, because it's exhausting. I mean, being on the phone constantly with people that you don't know, they reach out, this and that. And so at what point in your career of Ashcroft were you like, okay, I need to hire someone and remove myself from handling every conversation? Was there a milestone, or so what triggered that?
It goes back to when we were talking about when is the time to leave. When it becomes overwhelming for what you're really looking to do, which is preserve capital and continue to grow the business. So when that's becoming in the back,
like
and when that becomes a back burner, then you've got to fix some things. And, right now when you speak to investors, I imagine most of them know you whenever they're reaching out to you, and it's such a different conversation. I know it is when it's, oh, hey, Terrence. I've seen that you've done X, Y, Z. I just have a couple questions. Yeah, I know what you do. Versus, okay, I don't remember how I heard about you, but what business are you in? And can you tell me, what your business model is? And do you just do, are you an apartment investor? It's just a different conversation. So when you empower your investor relations team to elevate to the level of exposure that you currently have, well, now you're creating relationships at scale.
Yeah. Yeah, it's hard. People reach out. Chris knows this because he helped me set up the active campaign. We don't even return. I just don't even have the bandwidth to return emails. You know what I mean? Like, I am only doing deals with people that I know, and that's not a great place to be, but that's just where we're at. I don't have the bandwidth. And the few times I get on the phone, for me, it's exhausting, because it's like, why am I going to sit here and explain our business when I have 20 other people here that already know it? And so, I've just been really curious, because I do think that's the bottleneck for us. And I'm sure there's other people out there that it's the bottleneck for them. And so I'm just trying to toy with, because bringing someone new in, or even 2 or 3 people, like you mentioned, when we have a great culture and we have a great system and things going, I guess that's been my concern with it. But I love how you put it into 2 or 3 buckets and how those people work together. So I thought that was really valuable. And so at what point, how many years ago then would you say you were able to remove yourself and bring on these 3 people?
It was gradual, and it was 3 people. It's 3 people now, but actually it's more than 3 people now. The investor relations team is 4 or 5 people, but it can be 2. The marketing manager and CRM administrator at the beginning can be 1 person, and then investor relations person. It was a couple years ago.
Okay, cool. So 2 of the questions we love to ask on the Multifamily Mentor Show is, number 1, what would you say is your superpower? Going back to being self-aware, what is the number 1 thing that, separates you and that, really is your secret sauce?
My commitment. When I'm a dog with a bone whenever I'm focused on something. I've got the world's longest running daily real estate investing podcast. No one in the world has interviewed more real estate investors than I have. Wow. No one in the world has interviewed more real estate investors than I have. Show me someone who has, because, I've got 2,800 episodes on the podcast. Now, I don't do them anymore. I do 3 a month now.
Wow.
But the first 1,500 I did. So I've interviewed over 1,500 investors. I might not do things the right way, but I'm going to keep at it, and I'm just going to just through determination, I'll make it happen.
Amazing. Yeah, I love that. I mean, so much can be offset through just determination and perseverance.
Yeah.
You can make up for a lot of other errors and a lot of deficiencies that way. Number 2, talk about your view on mentorship and, maybe a few tidbits to the audience about, how it's changed your career and helped you. And I know you said you had a mentor and that's how you got into multifamily, I think, or brought you your first deal. So maybe your thoughts on mentorship.
It's necessary if you want to accelerate your growth. And my suggestion would be paid mentorship, because when you have free mentorship, the value exchange is skewed, where you might feel self-conscious asking all the questions that you want answered. Mm-hmm. And there's a lot of gray area on deals, right? There's a lot of different nuances of deals and getting started. And I feel like paid mentorship's the more professional approach, where, hey, I'm paying this person. I'm going to ask all the questions I need to ask. I'm going to get the help I need. I currently have a life coach or a business coach, and someone else like a personal development coach. So I've been paying for mentorship, not in syndication anymore, but in other stuff ever since I've been an entrepreneur.
Wow. Amazing. Yeah. Paid mentorship. That's been something we've discussed a lot, and I think is a really interesting topic. And I think that there's so many stories and so many people that have sat, not necessarily there, but on the podcast, that have gone through like maybe the same mentors you've had and paid mentorship, and the results are, astounding. I mean, they speak for themselves, of all the deals, all the capital raised, and like you said, the nuances, I think sometimes can only be learned from someone that you're paying that has real expertise in that area.
But it's also, and I know we got to wrap up, but it's also like, you don't enter a personal relationship with someone if you're not right. Mm-hmm. Right? Otherwise, you'll just bring the baggage into the relationship, right? You've got to get your house in order before you go try and find a significant other. Mm-hmm. Same with mentorship. You can pay someone, but they're not going to be the solution for you. No one's going to be. You're the solution for you. They're the guide. Mm-hmm. And that's what's important to distinguish between the two.
That's really good. That was awesome. Well, I wish we had more time. I know you got to run, and this has been a real treat. I know we're really humbled and honored for you to be on the show, take time out of your busy day and schedule. I know you got a big conference to run and to be at. So Joe Fairless, Chris Lopez on the Multifamily Mentor Show. Thanks for coming.
Thanks, Joe.
Thanks. Appreciate it.
You're listening to the Multifamily Mentor Show.
Join the conversation